You're about to join Jerry Parker, Moritz Siebert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Jerry Parker, Moritz Siebert, and I, Niels Kostrup-Larsen, are back with this week's edition of the Systematic Investor Series, where each week we focus on helping you build safer and better performing portfolios by including trend following in the mix, and where we do our best to answer all of your questions. Jerry, Moritz, good morning, good afternoon. How are things where you are today?
Good morning. Cold today, about 0 degrees centigrade, so cold winter day.
Very dark outside since we started very early this morning for this podcast, but it's Gasparilla weekend in Tampa, sort of our version of an all-day party, and the Pirates invade Tampa once again.
Yeah, big rookie mistake on my side, suggesting that we start recording at 6 a.m. Eastern time, because I just realized that the hotel I'm at, the coffee shop doesn't open until 7, So trying to fight through this recording without any caffeine today, but there we are. Of course, a quick review of what happened this week. I mean, I guess China sort of took center stage another time, not so much for trade negotiations this time, and also despite a lot of influential people meeting up in Davos in Switzerland, but of course China in the center of attention around the world for this coronavirus, which have forced them to put on some travel restrictions and other things in some cities. So that was the big news, I guess, and that kind of news obviously played some role in investors becoming a little bit more risk averse, maybe in stocks a little bit, but also we saw the influence of this in the energy markets that seem to have seen a big drop in enthusiasm the last couple of days. And I guess as investors became a little bit more cautious, fixed income markets actually had a little bit of a tailwind this week. Moritz, what were you watching this week? Any big moves? And we can, I guess, jump straight into how it all panned out on your side this week.
Yeah, some nice moves. I'm pretty happy and stoked up about my portfolio. I'm about 4% year to date. Last week was a bit more than 1%, so really good start into the year. Like you said, Niels, the last week was about the bonds, which I'm still long. So US bonds, Canadian bank bills, the euro dollar, all of that I'm long, and that made good money. Some notable positions on the long side that went well was milk, the CME milk contract. Small market, not a large position. Well, I have a smaller portfolio, but it worked. And for the shorts, I have a short position in crude, in copper. All of those were goods. And on the losing side, some of the equity markets, a long exposure to the China A50 index, to MSCI Russia, that wasn't so great. But anyhow, you know how it is. Some of those markets give and some of those markets don't. And it's a bit more than 1% for the week, so very happy about it.
Yeah, that's pretty good, actually. I remember last week you said you were getting longer in energy, but then so the crude side is something that has kind of performed differently or moved differently since you're short?
So I have some of the energy markets since a while. I have in gasoline and in gas oil different positions on selling crude. I mean, we've said repeatedly that those markets tend to be highly correlated, but not all of the time.
Sure.
And my signals in Brent and WTI, they were really changing quite a bit over the past couple of months. And now I am net short again, only since a few days really,
yeah.
And this has worked.
Good for you. On our side, a different picture, I would say. This week we certainly gave back some of the early gains in January, still up for the month, but not as much. On our side, it certainly was the energy sector that had both winners and losers, I will say, but the biggest ones were to the downside. Unleaded Brent took a bit of a beating, but nat gas did pretty well. Fixed income, let me try that again. Fixed income did pretty well. So still like you, long, not to a large extent, but some long still there. Equities clearly gave way some profits with those corrections. I would say currencies, kind of a mixed picture. A few winners, a few losers, but overall probably flat overall. Lost a bit of money in soybean oil, but then the rest of the grains did okay. And then, copper wasn't a great market for us this week. We made a little bit of money in gold, kind of flat in silver. So, yeah, I mean, a mixed bag, but certainly a little bit of a headwind on our side. So, correction in terms of performance. What about you, Jerry? What's happening on in your portfolio at the moment?
Well, the big one is palladium, and that continues to skyrocket higher. Gold and platinum hanging in there better than the other commodities. This is kind of weakness on Friday or later in the week, and some of the softs and greens and things. So, I every day it's except Friday, the palladium was just out of control. Just like my Tesla position, kind of has these crazy up moves. I'm still long my smaller amount of bonds as well, so that's good. That was kind of been a choppy. It's a good example of why the data in the backtesting says, hey, you should trade longer term, because sometimes when you get crushed in these markets and you have these violent givebacks, they kind of don't keep going down. They just hang in there. Then all of a sudden we've had a pretty good week in some of those government bond futures. So that's a testament to holding on to a good trade, even though it gives back some profit. It may go back to the highs. So good for us and good for you guys.
Yeah, I read an article, I think yesterday, a headline saying that the move in palladium is costing the car industry, maybe it was just referring to the European car industry, but the car industry like $18 billion a year. I'm not entirely sure what they use palladium for in a car, but
it's like catalytic converters.
Oh yeah, that's what it was. That's right.
Yeah, it's a byproduct, I think, of mining platinum and nickel. I was on a couple of TV shows this week, small channels where I do 5 or 10 minutes of talking about the markets, and to varying degrees, these shows are knowledgeable and care about technical trend following versus fundamentals. So on one of them I was going to be on, and he goes back and forth between realizing that I'm just pure trend and, well, what do you think about so-and-so? So I usually enlist my friends on Twitterverse to say, hey, give me some fundamental information that I can speak about. But I did my own research on Google on palladium, and that's what I came up with. And he didn't really ask me too much about that either, so that was even better.
Yeah, well, I mean, we'll just have to wait for the headline to come out, and that says how CTAs and trend followers in particular are causing the the pain of the world car industry. I'm sure that's going to be the next topic.
Early 2000s, I was on a panel, commodities panel, like, I don't know, J.P. Morgan, Morgan Stanley panel in New York City, and it was me and a couple of guys who traded commodities fundamental, and we were comparing why you should use trend following or why you should use fundamentals. And one of the experts, famous commodities trader, he was talking about this 2006 copper move, and he was short. It was one of the biggest moves of all time in the LME markets, and copper was, and he said he was just short the whole way up, and just that was his analysis, and he just blew it. And so maybe we'll have the same thing one of these days, where we can see once again that just blindly following these trends, can sometimes outfox the really smart guys.
Yeah, absolutely. And I hear PT is also awake this morning, so even if we start early, he or she seems to be wide awake in the background.
She's not happy. She doesn't usually get up for another hour and a half, so she's expressing her displeasure.
There we are. Okay, guys. Let's see what happened in kind of FinTweet world in terms of topics, discussions that we can dive into. We have a couple of questions on our own later, but let's do what we normally do and see what happened in Twitter land.
Yeah, sounds good. I can't tell you how excited I was to read this article. It was like one of the best things I read in a while. It's the Hedge Nordic CTA roundtable, and I think it was took place back in January, talking about 2019 from these famous CTAs and maybe an allocator or two as well. And I think things like this are so amazing. I mean, it's not a video or an audio, but it's just a magazine article, let's say, but it's getting these guys together who sort of all trend follow or invest in trend followers, I guess, or CTAs. And I just thought this is a lot of fun. And not enough of this is done to get these bunch of people like this together to talk about the markets and CTA universe. And I thought, just so seldom do I read something that a lot of good topics and a lot of different opinions and maybe controversy here or there. So we'll go through some of these, and I just tweeted the hell out of it. I mean, probably 6 different times, the different quotes that I really enjoyed. So we'll beg your forgiveness if you get kind of like bored by it. But the first one is there are different ways that CTAs can do well during stock market declines. A large exposure to long bonds is one of them. In some market declines, protection came mostly from commodities, and other periods, protection has come from currencies. So I just thought, that's a great way to start because, what he's essentially saying is, we can be short indices as well, stock indices as well, but over the years, protecting the portfolio and adding value during a stock market decline has come from these other 3 sectors as well, and who knows? You can't predict, and it could be any of these 3, and that's the edge we provide sometimes is a well-diversified portfolio of longs and shorts, not just stocks and bonds.
I think that's a really important point, and it goes back to the whole philosophy about knowing what you don't know, and I think that's that's the role we have to play. There's no doubt, I think, that there is or has been this tendency for investors, rightly or wrongly, to definitely believe that when equities have their trouble, that fixed income will be play a big role in mitigating that. And we see that in different portfolio constructions. We know for sure that people like CalSTRS in their risk mitigation portfolio has not only trend following, but they also have a sizable allocation to long dated treasuries. But I think I think the conversation should also then include the fact that, as interest rates are getting much closer to zero in general, I mean, can that part of the portfolio really play that an important role if we have, when we have the next big crisis in equities? And of course, we don't know. But I think, as you said, the fact that we have all these other things in the portfolio, I'm sure there will be something that will help mitigate those losses that we will incur as well initially in the initial turn. We know that unless we have a kind of a long, prolonged top-forming environment like we saw in 1987, I guess, in equities. But if it's another February 2018, there's going to be pain in the equity side, but hopefully there'll be other things helping out.
I agree 100%. I mean, we only need to look back to the global financial crisis, during that, 2008, 2009 time period. It wasn't actually the shorts and the equities, but the longs and the bonds that protected the portfolio. So this is a case in point right there. But I agree with the observation. I think, the uncorrelated positioning of our portfolios, long and short, there could be any one market providing that cover if equities go down. It could be a currency market or a bunch of currency markets. It could be the energies. For the past many years, we've had this relatively stable negative correlation between bonds and equities. And every time there's been a risk-off environment, the bonds rallied, which kind of like, this is the way it worked. But has this always been the case? ? I don't think so. If we go back to the 1970s or maybe early 1980s, the correlation was probably different. And your portfolio benefited from, a diversified exposure to all sorts of markets. And if something bad in the equities happened, then maybe it's, I don't know, the Aussie dollar or the yen or something else that protects you or helps you out.
Well, I can tell you the answer to that much because I did the study a little while ago, and I don't think it's changed much. So, you're right. In the last 10 years or so after the financial crisis, I think this was based on maybe daily data. I can't remember now, but it doesn't really matter. But I think you're right. There has been a very stable negative correlation. I think 87% of the time there was negative correlation between bonds and stocks. But if you broaden it out to the last 50 or 60 years, it changes. Actually, then these two asset classes are positively correlated 66% of the time. So you're absolutely right. People are, banging on a certain correlation relationship, which really isn't the long-term true relationship between these two asset classes. And as I said, now with bonds being so close to yielding very little, we shouldn't expect the amplitude of those moves to help out as much as they have done previously, and therefore having other strings to play on, I think, is incredibly important. And of course, on top of all of this, we have all these risk parity strategies today that are relying on this 10-year correlation relationship continuing forever. So a lot of money will be disappointed when it doesn't.
I agree.
And you bring up a good point. How much more can bonds contribute? Because they've contributed. It's the only other sector, I suppose, that maybe, said many times, gold, that if you do a back test, it adds value, just on the buy and hold. And so now with zero, and it could possibly, anytime there is a sell-off in stocks, the government bonds have a tendency to rally. So it's, but how much can it even contribute? It's contributed a lot, and that's the benefit of what we do, is that it does contribute profits, not just helping to minimize the drawdowns and the ups and downs of a stock only, but it actually makes money. And so there's very few things that do that. Bonds have done that. Maybe they won't in the future. But there'll always be this thing that doesn't go anywhere until we get back to a more free market interest rate environment. But if you do have some big crashes, they'll rally, okay, or they won't go down. But not much of a contribution in the future, probably, until we have a big move down in the bonds, where that's where all the headroom is.
Yeah, but then on top of all of this, and I don't want to hijack your thought in terms of the tweets you want to bring up, but I think on top of these things happening, and as we move further and further into the stratosphere in terms of equities, it just seems to me that people are becoming less enthusiastic about trend. We've seen the industry bleed in terms of flows. Managers, the industry as a whole, have seen a lot of investors depart in the last couple of years. And generally, it seems like asset flows are going into less liquid strategies, very much related to equities, such as private equity and stuff like that. So it just seems to me that a lot of these flows are going in the wrong direction at the wrong time. But okay, people are getting bored maybe when they see equities go up 30% and the CTAs only go up 10 or 12% the same year. It's tough.
Haven't we seen this before? So many times. And the performance chasing of that is a real detriment to investors' returns.
Yeah. Good stuff, Jerry. Great start. What else? And by the way, I agree with you completely. I think what Cameron does in terms of getting these managers together. I had the pleasure of participating in a forum a couple of years back up in Stockholm, and it is great to be together with a lot of peers from our industry and debate some of these points.
Another one I liked is all of this demonstrates the dangers of pigeonholing yourself. And CTA trend following is it's crisis alpha against equities. It's rubbish because it's been manipulated and simplified. And so I'm a big anti-crisis alpha person, and because I don't think we should just exist. And they do get into it more, and one of the panelists does talk about, look, you guys only exist for helping us with equities. That's the only reason CTA should exist. And I'm like, that's crazy, because we have great systems. We have a risk-adjusted approach that preserves capital. We have all these other markets that can make just as much money as the equities. It's all been lost due to the past 10 years, but it's true and it's going to be true in the future. And I go on to say, why don't we, my comment to this was, if you really want crisis alpha, you know where I'm going here, and that is give us your stocks to trade that's in your portfolio that we're supposed to be helping, this dysfunctional portfolio that's just long a bunch of equities. And it's going to have a 50, 60% drawdown. It has, it probably will in the future. Now, can you guys with a 5 or 10% allocation, can you help me out here? No, we can't. I mean, we can say we will, but we won't. And we're not, and we have to trade suboptimal systems and time frames in order to make sure that when the S&P has a big sell-off, we can produce some crisis alpha. See, probably Friday, people were getting ready, right? Because the Dow was down 300 or 400 points at one point, and okay, let's get ready because we may have to go short here, even though I don't think that would probably be a good system in the backtest to go short anytime the S&P falls 300 or 400 points in a day. But you've got to get ready for this because this is what we're on this planet to do. But the fact of the matter is, if we use those same great systems, the trend systems, with all of these equities that they trade, if they allocated that to us, we could possibly help because that would be a much bigger benefit to the portfolio than a small allocation to CTAs.
Well, Morris provided crisis alpha this week.
Well, I don't want to call it that way, but if you allocate 1% to my strategy, then probably not. Didn't we just recently read a paper which said that some form of portfolio optimization leads to very unreasonably high allocations to trend following CTAs, such as 20% or more, which is so unreasonable because then you could actually get something out of it, but that's a different story.
Oh, if you let the numbers speak for themselves, it's going to be a huge amount. And these coming from people who make these decisions, who purport to care about numbers. And but that article goes on to make the bottom line was that we can't have that much dispersion or tracking error. So if you underperform or overperform, that's quite a bit of error there, tracking error to this holy grail of stocks in the S&P 500 that we're all focused on, and that becomes the bottom line. And it's just, I'm shaking my head. I mean, like, what planet is this? And just so drinking this Kool-Aid that smart people are coming up with things like this. Not their fault necessarily. They're just part of the group, and it's this groupthink. And it'll all come crashing down, and we just have to be there and ready with our performance and models and continuing to do the same thing and saying the same thing.
When I designed my portfolio, I said, what is my target? My target is to make money trading that, enjoy doing it if it's possible, and have a great risk-adjusted return that compares favorably to other strategies. The idea of targeting a tracking error didn't even cross my mind. What's the benefit of that? Who's being helped if you have a wonderfully small tracking error to an equity index? What's the point of that? I just don't get it.
It's like the Apple coming out and saying, well, we have this new iPhone in 2007, but it doesn't look quite like the BlackBerry. Let's make it look more like the BlackBerry because we don't want to get too far away from the industry standard. That's not a good analogy, but at some point in time, the CTAs will return, the diversification and systematic approach will return to having less risk and making more money than the equities. And then people will forget all of this silliness.
It would be so great if the starting point, kind of like, the entire market seems to be anchored to a long-only buy and hold investment to the S&P 500. Like you say, Jerry, it's the holy grail. Everybody needs to benchmark him or herself against that thing. But why is this the starting point? Why is this the market's reference point and anchor? Why can it not be, here's a bunch of assets that can be traded in a liquid way, long and short, and the starting point, therefore, is a diversified, systematic trend following strategy? That's your benchmark. Try to beat that. Start there, and then if you can and if you must, add other things to it, but not the other way around.
As time goes by, I feel I'm getting kind of more and more opinionated about this term crisis alpha. I have to admit, first of all, I love the people who came up with it. So that's for sure. But first of all, we have to remember that crisis alpha was coined as a term in 2011, and all of us have been doing this for a lot longer than since 2011. So of course we never had a mandate to deliver crisis alpha because it didn't exist as a term back in 1974, back in 1988, and all of that stuff. So, but initially when it came out, I'm pretty sure that I felt excited about it because finally we had a term that institutional investors could gravitate to, and they wanted it. They after the financial crisis, they wanted crisis alpha. So yeah, we need trend following, and we saw inflows going into the industry. But now it's turned against us, right? Because now investors realize that, well, maybe we don't really want crisis alpha because, equities continue to go up, and when they turn so quickly that the initial 5% we want to hedge because equities don't, or maybe 10% that we want to quote unquote hedge, we're not going to get any offset really from CTAs necessarily, which is true. We don't know if how quickly we react to that. So now it's become a little bit of a burden, I would say a big burden for the industry, that everybody talks about this crisis alpha. So yeah, I mean, I think we need to come up with a better term if we can, as an industry, really put our heads together, something that institutional investors can gravitate to, because I think narrative matters. There's no doubt that equities, and I had this discussion on on our side this week while I was in the office. I mean, equities has such a big emotional impact on investors. It's kind of almost like this is the starting point, and then we kind of put investments around our equity exposure, and clearly we fit into that narrative. But it also means that they expect us to perform in a certain way when equities go down, which we can't guarantee, and we're very honest about it. But as soon as we are, the enthusiasm for investing in the trend following strategy drops like a stone. So I think we need better narrative. I think it really is important that we come up with a different way to get investors excited about what we do and the value of what we do, so that it ends up, as Moritz was saying, so that it ends up actually playing the full role that it should, not just a 1 or 2% allocation, which is meaningless anyways. So even if we could provide crisis alpha, it wouldn't help the investor if they only allocate 1 or 2% anyway. So better narrative. If anyone has any suggestions, by all means, send them to us and we'll debate it, and we might even call you up and invite you to come and discuss it, because I think this is critical for our industry as we move forward.
Well, lucky you. I'm sitting right here. I'll tell you what. So I think it gets back to the heart of what we do, and one of the assumptions that we all have when we sign up to do trend following and back testing and system creation and design, and that is one of the initial ideas we have is that all of these trades, when you do the back test, they all have the same expectation. And so it's no cost and lack opportunity cost of trading currencies and commodities and bonds, long and short. And so that has not been the case. And so until that gets back to being the case, we're going to have a hard time making that argument. I read another article this week that talks about allocating and chasing performance and how to get yourself out of that and how it doesn't work. But it also said if you don't do some of that, you're going to have risk of losing your job. And so you could even find people who said, I understand how trend following works. Yes, all the trades you do, they have the same expectation. They're going to make the same amount of money as the stocks over time. Diversification's a free lunch. I get it, but I can't really make a big allocation to CTAs now. My superiors, I would lose my job possibly. There's career risk. And so when we get back to those normal times where the performance is just as good / better than stocks, and of course the diversification yields a much safer and less volatile portfolio at the same time, it's going to be tough. But I think you have to ask yourself, does an explanation that is purely just the truth, is that good enough? Is that something we can go with? And I think we should give it a shot. And just, what is the truth? And the truth is, and I don't really like this word because it sounds a little pretentious, but it's something I came up with when one of my friends sent me an email a few years ago. He's a CTA, and the title of it was The Perfect Hedge. CTAs are the perfect hedge. And I fired back at him, and I'm like, you know better than this, right? You know this is crazy. And he goes, yeah, I'm sorry about that. It's really the perfect portfolio, not the perfect hedge. And I think that's where we need to get with people and just say, look, really is our goal here is really to put it together in a way where you have all of these maximum diversification and maximum risk control without sacrificing profit. We're going to make more money than stocks, or just as much, with lots less risk. And until we get back to that, and we can honestly say to people, these markets, you're not losing anything by being in currencies and commodities, longs and shorts. And you can see the benefits of the diversification. It's going to be difficult, but I think that's where it all lies, is just sort of saying, okay, one of these days people will sort of agree with or trend following, diversified trend following goes away, doesn't work any longer, whatever. But I think that's where we have to go, because that's the truth.
I agree with that, and I like the fact that you mentioned this thing about the truth, because at least, and I'm sure we all do this, but I think what's really important for people to understand is that when we say that adding trend following to a portfolio of equities and bonds will build better and performing and safer portfolios, it's obviously not an opinion. It's a fact. It's the truth. There's never been a white paper written to disprove this, and so I'm just interested in finding out what assumptions are people putting into their decisions to come out with the result saying I should have no trend following in my portfolio. I don't get it. I can't imagine what those assumptions will be, or at least I don't think they will be very realistic. Of course, if we're looking at 1 or 2 or 5 years, we don't know if we're going to add value or not. That's not the point. But if you're looking at 20, 30, 40 years, which a lot of institutional investors have as their time horizon, I think your point, Jerry, and I think in general, I think we have a lot of evidence on our side that we should play a more important role in anyone's portfolio.
Look, every time I speak to investors, and what I sometimes do is I show the long-term performance of some select CTAs with a long-term track record like yourselves and the overall industry, and I compare that to other investment choices like long only buy and hold. All right, and I'm not using a legend on the chart, and I'm not telling them what's what. Of course, they can recognize what the S&P 500 is because they're looking at it all day, right? But when you then ask them, well, what is it that you want to have? It's a log chart, right? And you could even mask it and say, don't show them the chart, show them rolling 10-year returns or something like that. Every single one of them goes for the systematic trend following CTA curve because it is the best one with the least amount of risk. If you have them look at only of the last 5 years, they do not anymore. So to me, it is this human thing of being driven and being emotionally incapable of sticking to something and just chasing the next best thing. And because it has worked so well over the past 5 years, you completely forget and erase from memory what you've just seen and what you should be doing, and you reject to even accept the facts. And it is very difficult to really, in quotes, fight against this. It is the recency bias. And what is so amazing about this is that behavioral finance has a big megaphone these days, with Kahneman and Tversky and all of those great psychologists, Daniel Crosby. The internet is full of good material. There are many good books written about those biases and the emotional shortcomings when it comes to trading. And when you go and speak to institutional investors, they will nod their head. They will say, yes, I have been reading Thinking Fast and Slow, and I know about this stuff, and I've informed myself, and those biases exist. But they fail to accept the consequence in a way. it's kind of like, oh, it's very interesting to read about this. We're all lemmings in a way, dummies walking around. But you turn around on a heel and just go on with your life in the same way that you did before without changing anything based on the facts that you've just observed.
You bring up a good point. I mean, when I interviewed Daniel Crosby, and I recommend everyone to go and listen to his stuff and read his books. I think he's sort of doing a great job in actually also providing some of the narrative that we need. But one of his big points, and I'm not sure it's exclusively to him, but one of the points are, of course, that more knowledge doesn't necessarily make people better investors, right? I mean, people can, as you say, people can read about it. They can kind of nod their head and say, yeah, no, I understand it. But until they do it, until they implement it, until they take action, more knowledge just isn't very useful. And that's the challenge. And I think this is not just related to what we do in our industry, right? I mean, it relates to everything in life. I mean, you have to take action. You can't just sit and consume information and think, that's good enough. I mean, so yeah, this is important.
Yeah, I think I've said before how often would get in these meetings with institutional investors and say the same thing all the time, and they would like it and acknowledge it, and then I felt like, well, I would be much more likely to get an investment from each one of these individual people at the table with their own personal money than I would from this institution. And so I think, who are you answering to? They're always answering to someone else, and then ultimately answering to clients possibly who are the least informed, except they think they're informed because investing equals the stock market. And these historical massive drawdowns will all be in them because we've all decided to make stocks 90% of what we do. So that's going to preserve my career better than striking out on this risky behavior of saying, hey, we're 100% or 80, 70% diversified trend followers. And that is, regardless of performance, that's just not going to fly, regardless of the numbers and the data and the science. Out of one mouth, they're into the science and evidence-based and blah, blah, blah. But in another situation, we've had many examples of this.
And I also think that I mean, this is why to a large extent that every week we go on and we kind of say the same thing but in different ways, and we continue to deliver very consistently the same message. And of course, the one of the reasons we do that is that it's not enough for everyone sitting out there listening, thousands of people listening to our conversations every week, which we appreciate. But what we really hope is that every week just one person will say, yes, the coin finally dropped. I need to get this into my portfolio, so I'm going to go and do something about it. It's great to have a lot of people listening to the conversation, but what we really want is just 1-2 people every week taking action and doing this, because it's going to be a life-changing decision when the next big thing happens. And even if something doesn't happen, we know that building a portfolio of uncorrelated return streams is a great idea. And yeah.
And, can I just say a little bit? I think you and I approach this slightly different,
Sure.
Niels, because I'm listening to your words carefully. And you say it slightly different than I do. And I think this is another, not that I'm right and you're wrong, I'm just saying this is another way I think, I like my way better because it's not getting done in your portfolio. It's not getting Chesapeake in your portfolio. It's not what I'm talking about. Now, eventually, yes, that's what will occur, of course, when, with all right-thinking people. But that's not my argument. No, we're not getting CTAs in the portfolio. We're not getting trend following in the portfolio. I never say trend following. I say currencies and commodities, stocks and bonds in this maximum diversification, maximum risk control way. Don't you want to get these commodities and these currencies in there, long and short, along with your stocks and bonds that you already have, using this? How do you get them in there? They don't work buy and hold. You can't add commodities in mass like you can maybe gold, or like you could put into your portfolio like stocks who historically have gone up over time. How are you going to get it in there? You're only going to get it in if it's systematic trend or systematic in general. and let's go that route. Leave me out of it. Leave Dunn out of it. It's not about individual CTAs and industry or anything like that. It's like, how are you going to get safety in there? And plus, I mean, you could buy options, which will be a net loser. Plus, it's going to make money for you. It's going to be an add to your profitability, not a detractor.
No, I agree with that, Jerry. But you're right. We are saying things slightly differently because at the end of the day, I agree that people need this in their portfolio. That's what they want. And of course, it's not about specific names. It's not about, which manager that you ask to do it. But I actually think that step number one must be to go and find a manager to do it for you, because I actually don't believe that people are prepared to do the work, frankly, that it is required in order to implement long short across all these markets on their own. I just don't think it's a good idea, frankly. Most people will end up doing it wrong, and not really see the benefits to get. So yes, I am talking about finding managers to help them do it. But of course, the overriding theme is, like you say, you need to get it in your portfolio. Maybe we disagree on how to do it.
Well, your step one is my step two, and vice versa. But it's
right. Yeah,
we're still heading in the right
sure.
direction.
Yeah.
Cool.
What else happened at the Nordic Hedge Roundtable that we can dig into?
Well, we talked earlier about some of the large inflows this year going to short-term traders. Short-term CTAs are raising more money than long-term CTAs. But one of the people on the panel said some of these fast strategies are good on paper, but in practice, if you're trying to put billions of dollars to work to meaningfully provide crisis protection to a big portfolio, it's not going to be there. I think they're nice and niche in small size, but not in big size. So I'm not that familiar with shorter term systems that can really get in there and help. But people are raising, at least a few people are raising billions of dollars, but most of us are still committed to a longer term approach.
Yeah, I mean, I think it's a big debate, right? Clearly, the being able to say to people, "Oh, I didn't lose so much in February of 18, or I made money during this period where equities went down." I mean, that sells really well with investors, and of course, as we know, that is more likely to be a short-term strategy that can just be in the right position quickly after a turn, etc., etc. And I don't want to sound critical of short-term versus long-term, because a lot of the guests on the podcast are from the short-term space, and I have lots of respect for them. But I will say that there are very few, there are some, but there are very few short-term strategies that have been able to compete with a long-term trend over time. In a single year, sure. In 2 years, perhaps. But long-term, I haven't really seen it, frankly.
If you buy a cheap copy of TradeStation and do a backtest on trend in diversified markets, you can't really it's hard to find a systematic approach in medium to long term that doesn't work. So, I mean, at least historically. So it may not be that great. You could always improve on it over time. All of us have definitely improved a lot over time. We get better and we figure things out. But that's the beauty of these trend following models that are medium to long term, is that you really can't find any that don't work in a broadly diversified portfolio. That's not even optimized, overly optimized. It's just an easier game to play, even though, and the hard part about it has been recently the diversification didn't really help compared to the stocks, and then the drawdowns. The drawdowns are difficult to stomach, but historically there's drawdowns and there's lots of profits.
And of course, like with everything else we talk about in terms of diversification, it's not really a question of one or the other. Should I have a short-term manager or a long-term? You should have a little bit of everything, right? That's the point. I mean, they probably work well together. I would still I would overweight the longer term, because I think, as Jerry, you point out, I mean, there's a hell of a lot of evidence, not least from Chesapeake and Don, that it really does work in the long run and continues to work. But, and also I think that, frankly, competition in the short-term space, where your edge sometimes is linked very highly to where the server is located and how quickly you can get in and out. And as you point out, there are capacity constraints when you trade short-term. So you would imagine that it's harder to keep up, and you're competing against Renaissance Technologies at the same time. So that's not easy.
I like them. I mean, just like you said, it's for a smaller portfolio like my private portfolio, it is a very relevant addition because it is uncorrelated. I'm invested in a short-term CTA who I really like, who I think they are successful. They have a long track record, and they're doing something that I myself cannot do because I do not have the equipment, I do not have the co-located server and all that type of stuff. I'm paying a fee for that. Within their trading program, the transaction costs are 6 to 8% a year already, right? So I'm like 6 to 8% behind, and yet they're able to crank out some money out of those markets in a very uncorrelated way to my longer-term trend following portfolio. But I do like them because they are systematic. They run a system. They're not, shooting from the hip. There is something, there is a structure, there is some inefficiency in the market, which apparently they're able to exploit. It's something that I cannot do. And so from a portfolio perspective where I think, well, I'd like to add many different systems. They must be systems. That's a requisite. But add many of, those different things together, that's a great thing. So I like them. But of course, if you are a very large institutional investor, the capacity constraints of that industry are, so much harder than with us on the longer term side. I mean, maybe the overall capacity for those shorter term guys is, 10 billion or something like this. There just isn't more. Else they would have too much slippage, too much market impact. They couldn't produce the returns anymore because the holding periods are too short. Whatever it is. So if you have a 200 billion portfolio, you won't be getting all that much from your short-term allocation. You'll get much more from the long-term.
Do you guys think it's harder to find a good short-term manager than it is to find a good trend follower? Because there's been there was a big short-term manager last year that's been in the industry for a long time that closed shop. I know, of course, the one you're thinking about, Moritz, and I agree. That's a great shop. I can think of one or two other people that I think are doing great in the short-term space. So yeah, they're out there, but it's not that I have a long list of them. I can name a lot more trend followers that I would be comfortable with than I can on the short-term side.
I also know the one that you're talking about, that closed shop. Maybe they're surely more than 5. There are many smaller ones, but really I could probably list 5 who have, say, more than 200 or 300 million in their programs, and maybe there are 6, but off the top of my head, I could probably name 5. That's it.
And then there's some over the years that have criticized and made fun of long-term trend followers, CTAs who trade like we do, who've seen the need to have a longer look-back period to maintain profitability, because we've turned our back on Crisis Alpha in providing this stock market risk reduction. And so I'm like saying, hey, look, if you're able to trade shorter term and provide Crisis Alpha consistently by shorting the S&P before it crashes 50% or has a bad day or bad week, that's the new Crisis Alpha. That's the new crisis, is that we're at all-time highs a month or two later, but we had this huge crisis over a week or so. Then if you can do that, do it and pat yourself on the back. We can't do it. Leave us alone, and take us off the Crisis Alpha list, the long-term CTAs, and we're more of this perfect portfolio, which is like a punchline now, because you're not a very good portfolio, not nearly as good as my stocks only. Okay, cool. We can deal with that. We'll eventually, hopefully, get back there with the systems and the markets. But until then, all you short-term guys, you're the Crisis Alpha. Leave us alone. Do your thing. Figure out ways to get more capacity. You're so darn smart, and you're better than all of us, which is true. If you can make money in a shorter term system, you're much better off. Everyone's going to flock to you, whether it's Crisis Alpha or not. I mean, one of my questions is, if you can find this short term guy and you really believe in them, and they're making consistent money over time without these large drawdowns like everyone else, why do you even have any money in stocks at all? You've already found something tremendously superior. Why are you even thinking about how is it going to help me with my equities? So it's just a nonsense argument. But I'm really in favor of more of these short-term guys taking up that mantle and leaving us alone. Just figure out ways. You're smart enough. You're where you are now, so keep going and figure out a way to create more capacity.
I like the term "the perfect portfolio." So maybe that's how we need to talk about what we do.
That's definitely our attempt. I mean,
Yeah.
I don't know. Does everybody go into meetings and say this? That we're really trying to give you something. I know you're not going to utilize it, and you don't agree. But is it okay for my bottom line to be something that's amazingly great? That even though you're going to put 5% in or 0% in, but that's my goal. Is that okay? You think I'm okay doing that? I mean, it's obvious. This is what we're trying to do. And like I've said, when you and I got going in the industry, Niels, and even working together, it was people would bring up charts. Here's the 10 biggest drawdowns or bear markets in stocks, and here's how CTAs did during that period. And we would always do better, add value when stocks, 2008 stocks were in a bear market downtrend. That evolved somehow into Crisis Alpha on bad days, bad weeks, bad months. How did you guys do, on that specific short time period? It's really unfortunate.
Yeah, no, absolutely. The whole concept of time frame has changed, and I wonder maybe that is part of why we are being held to this really high standard now, where we almost have to give negative correlation, which is, by the way, a completely different topic. We can talk about the confusion I think people have between non-correlated and negative correlation, but the fact that we now have to provide this negative correlation even over a few days or a week. And I wonder whether it's just because we now all have instant, massive amount of information through the internet, and so our thinking, our time frame has been shrunk by everything being instant, including what we expect from our trend followers. I don't know, maybe. Were there any other things you wanted to bring up, Jerry?
Yeah, let's talk about two more.
Okay,
Save the best
cool.
two for last.
Oh, cool.
This is one of my favorites. I agree with the first part. I don't understand necessarily the second part. So I'm glad you guys are here to help me out on this. The only measure that controls downside risk while not hurting profitability is diversification over different trends. Beautiful. Love that. This will typically lead to a higher daily volatility without longer lasting deep drawdowns. I didn't understand why trading more markets would lead to higher daily volatility, but obviously longer lasting drawdowns, you shorten your drawdowns probably by the more diverse your portfolio is.
I'm not sure I can help you with that. Actually, I don't understand why that would lead to higher daily volatility either, frankly.
I would say the opposite should be true, right? The more diversified your portfolio, the more uncorrelated everything is, the smaller the daily volatility expectation.
And then finally, this is the kind of one that I just shake. This is kind of like not true. This is not true, but this came from an allocator on the panel. The real value of CTAs, as I see it, is as a diversifier to equity holdings. It's not because you want returns. If you want returns, you buy stocks. And CTAs cannot compare to stocks in the long run. Well, number one is that's the only way we compare favorably is in the long run. My definition of long run, this person's definition of long run might be 3 or 4 years or 5. But certainly in the long run, diversified trend, long and short, systematic trend following makes more money than stocks. And it's risk adjusted as well. So we just don't want ourselves to fall into this trap of it being true because it's not, and it more than likely will revert back to what the evidence really is over a long period of time, is that CTAs are really the only investment you need because they trade all the markets.
Well, I mean, again, I think you're probably I don't know who obviously said that. I haven't read the transcript that detailed, but I'm guessing that it's someone who's taking a relatively short view on time frame, and all I can say is that in the 45 years we've been doing this, we have outperformed the S&P. So the fact that someone thinks that you get more returns from equities than you get from a trend follower is based on the evidence, not true.
100%.
Anyways, let's jump to some questions. We've got a couple of questions this week, but the first question we have from Andy actually came to us via our voicemail, which always excites us. It makes it a little bit different. So let's jump to the first question this week from Andy and see what Andy had to say.
Good day, fellas. This is Andy calling from Toronto, Canada. First of all, I just want to thank you guys sincerely for everything that you do. I truly believe that Top Traders belongs in the AAA tranche of financial podcasts. So thanks again for everything that you guys do for us. So my question today has to do with the trading of CFD products. It goes without saying that there is a terrible amount of leverage associated with these products, but I'm just wondering if you guys can chime in on some of the lesser known facts associated with these products, particularly things to keep top of mind with regard to liquidity of these products. So if you guys can provide any sort of color as to the pros and cons of these products and anything we should keep in mind when building a portfolio of these guys. Alrighty, so thank you for taking my question and looking forward to the episode. Cheers.
Thanks so much, Andy, for your kind words, and let's see if we can collectively come up with something that helps you out a little bit regarding your question on CFDs. Now, I personally have never traded a CFD, and we don't do it at Dun either, so I will like to start deferring to one of you guys that may have an idea, but maybe, I mean, Moritz, you're always very good with kind of definitions, and maybe not everyone listening to us today know what a CFD is. Is there an easy way to explain what a CFD is and how it's different from a futures contract? Because CFDs, I know that Andy was calling in from Canada, but CFDs were very popular and maybe still are in the UK, I know, because I think there are some very favorable tax treatment of CFDs. So do you have a little bit of a insight that you can share there, Moritz?
I'll try my best. First of all, definition, CFD stands for contract for difference. It is a leveraged product, a leveraged delta product. It's not an option that is nonlinear, but it's akin to a futures contract in the sense that it gives you leveraged exposure to an underlying reference asset. Let's take an example. Say crude oil. Assume crude oil trades at 60. You can buy a CFD, a long exposure CFD on crude oil that will give you exposure to that market, but in a leveraged way. It may stop you out if crude oil touches 30, in which case it's 2 times leverage because you would pay kind of like the intrinsic value. You would come up with $30 to, trade something that's actually worth 60. And by that example, if you move that stop, the intrinsic stop of the product higher and higher, closer to the spot price, then the higher your leverage will be. And I have no actual trading experience with CFDs, but unlike a futures contract, they're not, I don't want to say they're unregulated, but they're not trading on a regulated futures exchange. They're trading in trading portals, kind of like OTC trading platforms, many of which I think are geared to retail investors. And a lot of the activity apparently seems to be in the currency markets, where there are platforms that offer exposure to currencies in a massively leveraged way. Leverage of 1,000 times or even more than 1,000 times is not unheard of, which means that, if you're 1,000 times leveraged, if something moves by 10 basis points, then you're already liquidated at that point. So it's kind of like a tiny move in the market and you're out of the position. So I don't think if you wanted to build a diversified trend-based portfolio using CFDs, I don't want to say that that is impossible, but it wouldn't really work with those highly leveraged products. You would have to, I think, select contracts. They can be leveraged. We're trading futures; those are leveraged, right? But it needs to be within, within reason, I'd say. And then it's possible. I don't want to look. The beauty to me, the futures contracts, the implied, basis or the funding rate in those futures. This is the aggregate rate of the overall market participants, which is, there's lots of volumes, lots of institutional players, very efficiently priced, tightly priced. In those CFD products, this is not necessarily the case, right? So the funding rate that may be implied in the CFD to give you the leverage exposure may be very high, meaning that, the forward or the futures price that you pay is higher than it should really be. And that may be a drag on your portfolio when you trade those products. But other than that, I'm not the expert.
No, I mean, I think you bring up a couple of points that might also be relevant for Andy. And of course, I think it is something. I think it is a product from my limited knowledge that you can certainly get started with smaller commitments than a futures contract and all of that. So there could be some advantages for certain types of investors. But anything that's highly leveraged, you have to be super careful. So be aware of that. But it is also a product that has other kinds of risks. I think you probably alluded to, because I think the counterparty risk that you kind of try to eliminate through futures, having it on a regulated exchange. I think with a CFD you do have a counterparty risk, like if you did a currency forward as opposed to a currency futures, right? So be aware of that as well. You need to find obviously solid counterparts if you are trading CFDs that can honor their commitment, especially during crisis times, where we saw, of course, last time that some financial institutions disappeared, so to speak. So is there CFDs is something you've ever had experience with, Jerry?
I have. I wanted to trade single stocks, and at some point in time in my career, that was a good avenue to go down. And it was probably I did it in Europe. Not the U.S., but the only comment I would have is that it sounded like Andy was concerned about the leverage that people use, and I think maybe it's the OTC part or the leverage part or the fills part wasn't fair, but I think you can get a fair amount of leverage on futures and interactive brokers. If you're trading stocks, you can get a pretty decent leverage there as well, as much as you may need. But I think if these products are helping for people to abuse the leverage and get themselves in trouble, then I think stay away from that. But there is a lot of different avenues for trading and using the proper amount of leverage with futures and a prime broker.
Yeah, cool. And thanks again, Andy, for trying out the voicemail. toptradersunplugged.com/voicemail, I think, is the link if you want to. If you want to leave a comment, doesn't even have to be a question. It could be just a comment. And if it's a good one, it may show up on the show. Next question is from James. Hi, James. Thanks so much again for putting through a question to us. This question goes like this. What are your opinions about where the line is on curve fitting? Should we be including instruments or synthetic instruments that rarely, if ever, make money, where the trade stats are very poor? I would imagine one needs some level of evidence/confidence that an instrument has at least exhibited a trend in the past, ? However, a system building process which excludes instruments that exhibit low average returns, let's say over the past decade, appears to be a form of fitting. Perhaps after 50 plus instruments, this becomes less relevant. Good question, James, because I think it touches on one of the hardest things that we do when it comes to research, and that is, which markets to include, and also essentially how to construct the models. Meaning, we know, of course, the challenge between using, when you use universal parameters in your portfolios, there are some parameter combinations that obviously doesn't favor certain markets, and while they may favor others. So I think it's just a generally quite an important and really difficult discussion. So we've touched upon this many times, and I'm sure we will in the future as well. So I'm gonna just jump to you guys and hear what your thoughts are in terms of James's question.
Okay, I can think of two markets. I think it's corn and wheat. Those two haven't been doing really well in my portfolio lately.
When you say lately, can you define that, by the way?
6-7 years.
Okay.
But over longer periods of time, they have made money. I don't think there's a single market in my portfolio that hasn't made money if I test it long enough using my trend systems.
And what is long enough? Sorry to interrupt you, Moritz, but I want to.
Well, with wheat, you can go back to the 1920s.
Yeah.
Right. But
Okay, but what for you? Because I think this is actually so super important.
So long enough. There is no definition of long enough. I have Bitcoin in my portfolio, as does Jerry, and there is no long enough. I mean, I'd love to have more data on Bitcoin. I just do not have it. Right. I have included it because it is highly diversifying, and my belief is that a trend following trading style on that market will work. I have included last year, as I have mentioned here, the CYMEX or the Singapore Exchange iron ore contract. Again, there's not 30 or 40 years of data on that contract, but I trust that a trend following trading style on that market will work. So I put them in. It is not a requirement for that market to produce immediate positive P&L. So if I, my backtest on the iron ore contract may show a loss for the past 3 or 4 years, and so what? I still put it in. I want that as a diversifier in my portfolio. So just the raw P&L shouldn't be shouldn't be your parameter and your guiding principle here, I think.
Can I ask? I agree with what you're saying, but can I ask just to help our listeners a little bit? If you look at your portfolio as a whole, forget about the markets at the fringe that where we can't get the data, but let's just take the core markets where we have data going back to, say, at least early 80s. Some markets, of course, came in the 90s, but let's just call it, In your opinion, I have two questions on my mind. One is, how long would you usually test your core portfolio on in terms of data? And the second thing is, do you think more recent data is more important than the full data set? Because, of course, some people will argue, well, markets change, so you need to put more emphasis on more recent data. I mean, how do you think about these things, Moritz?
I want to take all the data that I can possibly get. Some of the markets I've just mentioned, wheat, you can get almost 100 years, or maybe it is 100 years, even I don't remember off the top of my head. Most of the markets, on average, I'd say we have about 30 years of a history. And I want to use all of that. If a newer market comes up, like Bitcoin, for instance, there's a 2-year history available, so there's not much that I can do. I still put it in. Now, is more recent data more important to me than data that stems from the 1980s? This is a really difficult question, and I'm sure that traders will have different opinions on that. And you will find quite a few that will say the more recent data is more important to me because markets now trade in a different way, and there's more electronic trading, and there's a combined session and no longer just the floor session, and there's different participants, and it's more global, and this, that, and the other thing. You can be in that camp, and I kind of get those points, but to me they're not sufficient. I give as much weight to the current data as I give to the past data. I really treat it all in the same way. And maybe this is just my, for simplicity purposes or my simple mind, but it's also kind of like I say, well, at the end of the day, it's humans either designing algorithmic systems that automatically now trade in those markets, because as we know, most of the volume is traded electronically, and certainly that hasn't been the case in the 1930s, right? Or in the 1980s, to the extent that we have it today. But a human being needs to program that algorithm. So at the end of the day, it is some form of human interaction that happens in the markets, and why should that? As we've just said earlier on that podcast, with all those biases, the recency bias and all that, we have all that knowledge. We don't seem to be able to change and come to the right conclusions. So why should I expect that, to change, and the human behavior that makes up all those prices to change and be different now than it used to be? So this is kind of like a philosophical thing. I don't want to say that my point here is correct. I have no way of proving it. It's a matter of taste, I guess, at the end of the day. People can do it whatever way they want. Be happy with your approach. I'm happy with mine, and I like all the data and treat it in the same way.
What are your thoughts, Jerry?
I agree with all of that. I'm pretty sure. I meant one probably a little bit more radical, that I wouldn't take into consideration historical performance as it relates to including things in my portfolio. I'll include everything. It's just based upon diversification and liquidity. But even if I have three markets like crude, heating oil, and unleaded that are 90% correlated, sometimes, most of the time, then I will still trade all three, but at a reduced size. And I don't look at performance of each individual market historically. I just don't look at it. I look at here's the average trade, average win, average loss, win percentage of the entire portfolio, all the stocks, longs and shorts combined. I want to kind of stay away from slicing that data, commodities only, longs only, stocks only. So I think that goes a long ways to preventing you from doing things that are sort of fitted to the past too much. So I'm going to totally ignore historical performance. And since I'm trading every market the same way, which is a critical ingredient to robustness and not overfitting, then when a new market comes up like Bitcoin or something that has less data, I don't care. I mean, if Bitcoin had 200 years worth of data, would it, when I did the back test, the bottom line is, would Bitcoin, 1 out of 100 markets that I'm testing, would it create a different system of parameters? Would I trade differently with more data from Bitcoin? No, I would. It's not. One market is not going to make me trade a shorter term or longer term, right? So that's another thing I hang my hat on. Like Moritz said, all of these things you can just take down. No, recent data is better. I'm a scientist. I'm a PhD. Trust me, recent data. You shouldn't trade all markets the same. You shouldn't assume that all markets have the same expectation. Well, okay, cool. But once you start with these building blocks of what you really believe in, it leads you, I think, down, at least for me, into a path where I'm not as creative as most CTA research departments, but I am always defaulting to robustness and fewer parameters and fewer degrees of freedom and less fitting.
Sounds like Petey has an opinion about this. She's getting very excited about this topic, which is great.
She's very upset with that picture I posted. She's a little similar to my wife. Like, get rid of that picture. It's not a good picture of me. So the picture I posted, I don't think she was, her hair was messed up, or her feathers were out of line, I think.
But I mean, it is a very, very interesting and I think super important topic that we just touched on here. And I think one thing, I mean, I like what you're saying. I like kind of the, kind of don't pay too much attention to what's happening recently. I think that makes a lot of sense. I also get the feeling that the more and more machine learning that goes on in our industry, then more and more the opposite is happening, because machine learning is essentially trying to optimize based on the data it's being fed, and it's to a large extent not 50-year data. It's more like the last 50 months worth of data. So
maybe they're doing us a favor by rendering all of that short-term analysis unusable because there's too many people doing it. And so, so maybe we should just embrace, the back test, the sample size.
Right.
I like that.
Yeah. All right, guys. Thanks again for the questions. Keep them coming, by the way. info@toptradersunplugged.com is where you can email us if you don't want to leave a voicemail, and we will do our best to give you some useful answers and opinions about these things. As we start to close down this week's conversation, let me quickly run through the performance. Obviously, we're still in January, so the monthly return is the same as the yearly. Beta 50 up 1.4%, SocGen CTA index up 2.26, SocGen trend up 3.03, SocGen short-term index up 0.91%, and the bridge alternatives index up 2.04%. So a decent start for all CTA indices so far in 2020. Any final thought? Let me just say, maybe before I go to that I think I mentioned it last week as well, that I've just released a new version of something I call the Ultimate Guide to the Best Investment Books. It's a guide with more than 100 titles to some great books. So if you want to grab a copy, it's completely free. Just go to the website, toptradersunplugged.com, and in the top banner, you could download your copy today. Anything else? Obviously, we three of us are going to meet soon. We're going to go with Andrew to watch some basketball on Tuesday. Very, very excited about that. So appreciate what you're doing here, Andrew. And we're going to see each other a few times next week at the conferences in Miami. Anything else? Except I like your Moritz's, your schedule. You're going to have on Tuesday. You're going to have breakfast in Barcelona, and you're going to end up with basketball in Miami on the same day. That's pretty extravagant.
That's right. Even though the breakfast is going to be on the airplane, so not a very extravagant breakfast. But you're right on that, and I'm really looking forward to seeing you guys and meeting Andrew in person, and just having a great time with some like-minded friends and catching up. So.
And maybe more of our listeners will be in Miami. We would love to say hi if they are.
Exactly, say hi and try to reach out. We're on Twitter. We're on LinkedIn or whatever. Send us an email, and where we can, we'll be happy to meet for a coffee or just chat.
Absolutely. Any final thoughts from your side, Jerry? Or
no, I enjoyed the podcast. I look forward to seeing you guys next week for some basketball and food. Drink.
Yeah. And talk about the perfect portfolio, of course.
We've got so much to talk about. Yes.
We've got so much to talk about. So on that note, let's wrap up this week's conversation. We hope that you enjoyed it as much as we enjoyed making it for you. And if you haven't already done, please share the podcast. Tell your friends that this is definitely, now we have it on record, a AAA rated podcast for finance. Thanks for that, Andy. From Jerry, Moritz, and me. Thanks so much for spending part of your day with us. We are grateful for your support, and we can't wait to be back with you in a week's time.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.